Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jornay, partner here at the firm. Eric, how often do you get on the phone with the IRS?
Oof, I try to avoid that as much as possible because as it sits right now, talking to the IRS is one of the hardest things to do.
Really? Is it just the wait on the phone, or just when you actually talk to them, it's painful too?
There are the demand and the supply are totally imbalanced right now. So the people that need resolution with the IRS is much greater than the supply of available agents. And I
understand there aren't a lot of people at the IRS as opposed to how much work they have.
Correct. And what's great is we got extra money allocated for them to grow. Mm-hmm. But guess what? You know, how long does it take for somebody to get up to speed and learn the IRS code that can, there's something out here. If you laid it page by page, it like revolves around the earth like 100 times or something crazy like that. We would probably fill this room with paper, just with IRS code.
And the IRS code is all encompassing, right? Like it's larger than tax code just by its default, right?
Correct. Well, yeah, IRC, yeah, and there's so many other components just like the tax code.
And that's what I mean.
We have private letter rulings. We have announcements, all sorts of different ways in which the IRS makes rules and determinations on how different subjects are handled.
And as we've brought up before, just their list of acronyms could be its own book, right?
Yeah, or there's even code sections, and then you have experts that are called code heads that can just, that's a 283B violation. It's a 283B violation.
So obviously you don't want to deal with the IRS. No one actually really wants to deal with the IRS. And honestly, the IRS really doesn't want to deal with you.
That's
right?
correct.
In a perfect world, you wouldn't even communicate.
We're frolicking in a field of daisies together.
Obviously we don't live in a perfect world though.
Nope.
So tell me, Eric, what are like the top red flags that the IRS is going to be looking for, and therefore everyone should just avoid?
Yeah, definitely. No, this obviously goes way beyond like blatant cheaters, right? Hey, I'm funneling money somewhere.
You're racketeering. What you're saying?
Racketeering. But let's look at this from a lens of probably a business owner, right? Who's going to be our average listener? Mm-hmm. What are the things that are going to get noticed by the IRS? The most important one I have is listed here is what's called the reasonable compensation. This is a concept for S corporation shareholders that work inside their business. Mm-hmm. So what the IRS requires an S corporation shareholder to do is they have to pay themselves on a W-2 a reasonable amount for the services they provide back to the business. The play with an S corporation is profits from an S corp are not subject to Social Security and Medicare tax, which can be pretty substantial. It's a common tax planning technique is to control owner's comp and to maximize flow through profits from an S corporation. Very common tax planning technique. The IRS says, hey, you just can't go all willy-nilly on it, right? It has to be some science behind what reasonable is. But let's talk about the biggest red flag, zero comp. We'll see this from time to time, especially in the marketplace, right? Owner of an S corp. Somebody said, hey, business owner, you're an LLC. Why don't you be an S corp? Okay. I've never ran payroll before because the sole member LLC doesn't run payroll, or neither does a partner in a partnership. They do not pay themselves on payroll. Well, now I'm an S corp. Great. I'm saving all this money because somebody told me to do it. Well, now we just created a really big red flag because all my income is profit and I have no compensation.
You're not paid.
Correct. So we're taking distributions from my business. The IRS comes in and they say, this is not reasonable. We're actually going to recategorize this as wages. Now you owe back payroll taxes. And what we know about back payroll taxes is they have substantial fines and penalties to them. So yeah, that is actually a focus for the IRS. because that has been abused so badly recently, they are focused on that particular subject.
One thing I would add, and I'm sure this is applicable for all of these red flags. The reason these are the red flags is because they're the most popular.
Yep.
So
exactly.
they know like
Frequent.
These are what people are doing, whether it's by choice or by accident.
Yep.
So now they are aware of it, and therefore they're focused on it.
Exactly.
So what else is there?
Number 2 on my list is the earned income tax credit. So
The ERCs?
No, not employee retention credit, right? We're going to put that in its own box, right?
Okay.
That was a short sprint we had. That program might be over.
Yep.
Who knows? Earned income tax credit's been around forever. So it's for low income taxpayers, especially those with multiple dependents.
Okay.
Big red flag for the IRS because it is one of the most abused credits, right? And especially for those that are self-employed. So the earned income credit, first of all, it's a refundable tax credit, meaning that it is money that can just get paid. So sometimes you have non-refundable credits, which can reduce tax that you owe, but refundable tax credits are money that can come back to you above and beyond any tax that you owe. So if I owe 0 tax and I have a $10,000 earned income credit, I got 10 grand from other taxpayers, right? I'm taking from the pool.
Okay.
So because it's refundable, you don't have to offset tax. This is a popular incorrect strategy for people to maximize this, especially through self-employed income.
Okay.
Right. So
like an LLC would be doing this?
Yeah, you could be a sole member LLC. And I know if I have $20,000 of taxable income and multiple dependents, that is my sweet spot for maximizing my earned income tax credit. And because I to a certain extent control my income and expenses for that business, I can work the system and kind of cheat to maximize that credit.
So this is one of those where people are doing it on
People
purpose.
are doing that. They're adding in fake dependents. They're doing all sorts of crazy stuff. But it's the reason why anytime you have an earned income tax credit claimed on the return, your audit rate just goes up dramatically.
Gotcha. Okay.
So we get nervous in years in which business owners maybe have a loss in their business, even if it's a plausible loss, because now that raises the red flag, right? Even if we qualify it. Now, one of the things, say I'm an employee, I just have a W-2. I go through an audit. Really not a big deal, right?
Okay.
Hey, here's my source of income. It's my W-2. Here's a tax statement. Super simple for the IRS to do. They probably will never even talk to you. Maybe a letter.
They'll just look at it and be like, yep, good.
Earning as a business owner, right? Now you're responsible for record keeping for all of your income and expenses. And one of the things that they're looking for are receipts to substantiate those expenses. And what's really hard to manage and keep track of? Receipts. And sometimes IRS agents have a principle of no receipt, no deduction. And that's the easiest way to get hit pretty hard in a IRS audit.
So it is very serious when they want the receipts.
Correct. Yep.
Okay. What else is on this list? I feel like this is a pretty big list.
It is. There are lots of red flags, and a lot of them have to do with being self-employed. So the next one's losses from a Schedule C, a self-employed business. So I have either a sole member LLC or I'm just operating as a DBA or an independent contractor. And for multiple years, I'm running losses in that, right? Again, there's very low reporting thresholds for a Schedule C, right? I have a S Corp partnership, C Corp. I have to report a balance sheet. I have an FEIN number. I'm most likely running payroll. There's a lot more regulatory items. There's a lot more checks and balances within that than there is on just a sole proprietor reporting Schedule C on a personal tax return. Well, say you have losses 3 years in a row. The IRS says, hey, how does this person survive on that?
They caught on after 3 years, right?
Well, especially if you have other income. So say I get a W-2 from somewhere else, but then I also have my self-employed business that just happens to lose money every year, wipes out my income from my W-2, and I get all that money refunded. Actually, the IRS will go through an extra scrutiny process if you have 100% of your W-2 withholding refunded to you. So that is, and again, right, this is something that people have abused and that's why it's on the red flag list.
I've heard about this, and it's not. Does it also work with a spouse too, where like one person will have a business or they're doing great, and then the spouse will be just having another business that just tanks, but still open?
Yeah, we got it. And so then eventually the IRS is going to say, is this a hobby or a business?
Gotcha.
Right.
Yeah, that makes sense. And so really 3 years is like, or they may even be on it sooner.
Yeah. Yeah. I mean, your risk of audit, if you have a loss on a Schedule C versus even the $1 of profit on a Schedule C, is dramatically different.
What else is on this list?
Kind of similar in that vein is an imbalance of itemized deductions and income. So I'm able to take itemized deductions for, say, the state income taxes that I pay, my mortgage interests, charitable donations. Those are the big 3 items that you itemize. Well, say I have very low income, but I have greater itemized deductions, or maybe they're even more than my income, right?
Yeah. I guess it would bring up a big question mark. Hey, I'm not paying a lot. I'm not making a lot, but I have this huge charity deduction.
Yeah. Yeah. So the question is, where's the money come from, right? Maybe I had an inheritance, maybe I've stashed money all, but this comes across on a desk audit, right? Mm-hmm. Somebody manually looks at that return and they say, wow, they have more deductions than they have for income. How do they afford to fund those deductions, right? Are they going into debt to donate?
That doesn't make any sense, right?
There's a great principle out there is pigs get fat and hogs get slaughtered, right? Don't get too greedy.
All right. Is there more?
The last one, it's kind of out. It's kind of it's a normal issue, right? It's omitting income and not correcting it. Okay. Right. So sometimes it's purposeful, right? And I intentionally omit income so I don't pay taxes on it. Well, if there's a tax statement issued on that and you don't report it on your tax return, the IRS is automatically going to have a matching system and say, hey, you did not claim this income. Here's a correction notice. Now, say you forget to do it on accident, right? Or it doesn't come in the mail. And then you said, you know what? Remember that chair or that gambling winning we had? I forgot all about that one in my tax return. Great. We can go back and we can amend the return. Okay. Get it corrected. But if you wait for the IRS to correct it, now all of a sudden you're on their radar, right? Hey, we omitted income.
Is this kind of like the TSA all of a sudden where once you're on their list, they're kind of you're more likely?
I think if your file comes across a desk auditor's desk and they see that multiple years that you've omitted income, they're more likely to want to say, hey, let's take a look. Let's open up the covers, right? And let's just think about why the IRS or who and why the IRS would choose, right? The other group of people are going to be very high income earners, right? Because they're most likely going to utilize sophisticated tax vehicles. We're going to have multiple income streams. We're going to be investing in certain vehicles. We might be buying real estate and doing things with real estate to maximize their tax position. We're probably doing things a little
complex operations.
They're very complex. So they're going to target some of those because there's few of them, right? And there's a lot of opportunity for them to come in and make corrections and get revenue. But the IRS is going to look for the lowest hanging fruit every time. So, hey, are earned income tax credit recipients legit? Big one, right? And it's massive dollars that can flow out from our economy.
Wow. This has been a huge, there's no more, right?
That was 5. I promised only 5. I'm going to stick to 5.
I'm just saying, I feel like you could probably go on for days, but it's good to know that those are like the key ones. All right. Well, that's give me something to think about. I definitely don't want to get any calls from the IRS. So, all right, perfect, Eric. Thank you.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.